thank you guys for asking the questions and having, being present here with me today. And just so we know where we are, we have 3 startup companies that have typically the same questions. And we're here to troubleshoot what kind of questions and how can we assist? What are the things that are worth looking into? And what are the things that we just should let go until we go to a future phase, in our business? So let's start with the beginning. We're just going to go by the first name. So I think, Simon, I think you asked the question. You say Simon, right? Is it Simon or?
Yes,
Yeah,
Simon.
Simon. Okay.
Yes.
So Simon, you asked the question. Can you, if you don't mind, can you repeat the question that you just
Sure.
asked so we can go in and just develop on that?
Sure, absolutely. So initially when I had this was the back of a napkin idea, I was just doing some research. And then my next step was creating an LLC. And then as the company concept evolved and I have an MVP now I've turned this into, I'm in the fundraising. I'm now a Delaware C corporation, but I had expenses my year 1 of this company, year 2 in this company, and now, year 3, first year as an incorporated Delaware C Corp. When do I capture these expenses to offset the tax liability?
Yeah, that's an amazing question. So I want you to hear there are 2 ways this can go about, right? So the general rule, when you have a startup company, the expenses that you have initially pre-generating revenue phase have to be capitalized. You can only take whatever startup expenses, organizational expenses, which is $5,000. The rest, you've got to amortize over 15 years. No one likes this. Okay. No one wants to do this. So everybody wants to do that when they actually hit revenue. So the side to that is that the flip side to that is there are instances where you can take some of these expenses out. And when you say I develop something, what you do qualify as an R&D. R&D has a completely different set of rules. Okay. So if you're developing an app, if you're creating a better process, if you are improving, it doesn't have to be completely new and innovative for R&D. People stay away from R&D. They think it's only for the large corporations. Now, I mean, Amazon didn't reinvent the world of e-commerce. They just improved things and they continue to improve on their own processes, and their R&D costs are high. So, the first question, and I do have a resource for R&D that I'm more than happy to share with you. I have a resource sharing, what is R&D? If you're developing anything that has to do an application, a software, anything that would be value someone else can use. Okay. So I shared that with you. What do you need to track? Like, do I hire a contractor? Do I go on Fiverr and hire contractors? Do I have labor? What kind of cost do I have? That goes in R&D. So R&D comes as a credit, okay? Because you want to minimize the startup expenses as much as possible pre-revenue, okay? Does that answer your question? Because right now it's going to be real difficult.
Yes.
Okay. So the other piece to that is the expenses that you have or that you will have for you to be able to be in business generating revenue, they have to be planned out. So sometimes the best thing you can do when you have a development of, a business, hey, I'm developing a product, I'm developing a service, I'm developing a coaching program, whatever it is that you're developing, you've got to have a kind of like a forecasted stage. So this stage would require to me to put 10,000 in, the next stage, another 20,000 in, right? So think about it as you're constructing something, you're constructing an asset, you're constructing something for you to be able to sell. So that you can plan your expenses. So if I'm in December, I'm looking at, okay, when am I going to go live? Can I postpone this to January? So they need to be planned out. The best buddy or companion for a startup is being extremely intimate with the numbers. This is the place where people do not look at their numbers because they look at other things. How much do you think you can make? How much is it going to cost? When is it going to come in? Having that track is really creating that intimacy with your numbers that can really make it or break it for that business model that you're building. Make sense?
Mm-hmm.
Yeah. Any other question? What questions do you guys have? What's something else that you guys keep asking
I have
yourselves?
one, and it's one that comes up in this group often. I think our group is very typical of a lot of startups and founders. we have entered this situation perhaps while still working other jobs. So in a lot of cases, we're bootstrapping our own company. So we're putting our own money into our company. So we're paying income taxes on the money that we're earning in our other jobs, but we're putting it into a pre-revenue company, but we're still paying income taxes. And we're trying to figure out how to maximize our opportunities to mitigate those taxes, or if we can in some way claim those income taxes as expenses for our companies, so that we can get some benefit from bootstrapping our own companies.
Yeah, so that's a phenomenal question that you just asked. So one of the things that I would say is, you know, there's an easy answer and there's a complex answer. Okay. So depending how much money you make on your W-2 jobs, okay, obviously the more you make, the more complex the question becomes. But you cannot claim expenses, income taxes, even if you're an S Corp, you can claim it, right, on your business. It's just one of those things because the taxes are personal, and personal tax, income tax is not deductible. The only thing that's deductible if you live in a state that has income taxes, the state taxes that you can deduct, but they cheated on that because now we can only do 10,000. So I'm not going to go into detail because you already know my point with the IRS. So with all of that in place, what I would recommend is when you have a company where you bootstrap yourself to work, what you want to do is, how can I create revenue? One of the first things people miss is like they build something so complex that it takes them such a long time to produce revenue. Give me an example. What are you selling? What are you producing?
My company is a SaaS company, software as a service. So it's a digital platform. So information essentially what I'm selling.
So information. Yeah. Okay. So you guys could be in R&D space. So I want to share with you that resource for R&D because I think it's good for you to know. Even if you'll never use it, you got to be educated to know, can I qualify? Can I build something? Can I tweak something in it that I can qualify for R&D? Okay. Now, if you sell the product to other people and how you sell it, that's a different story. Qualify. Okay. Everyone that builds a SaaS company has to have R&D in the back pocket. The other piece I would say is, can you create a model for your business where what you can do is, can I sell something today to generate revenue that unlocks you to be able to claim these expenses? So if you're building a SaaS company, so I remember this girl that reached out to me, and it was like many, many years ago, and it was such a brilliant idea. So she was building an app for scheduling for students. They could not schedule their time, something to help them scheduling their time, being productive to, when you are really into a lot of exams and all of that. So what she did in the meantime, I said, okay, the app is going to take some time. We have to get improvements on that. So what she did, she had some like sheets. She would go to speak to people, and she would have like a paid, like a cheat sheet, say, oh, you can do this, like checklist formats that would help the people. You can download it right now for like $4, $7, something like that. So she did that to generate revenue instantly. Number two, before the app was even launched, okay, what she did, she created this journal that she sold the journal. You can get it done so easily. You can get almost like it's inexpensive. I'm not saying you have to do that, but what kind of alternative revenue models, what else can you bring in to your business that you can generate cash before you're ready with your app or what the bigger thing that you're producing? Okay, that's the one thing.
I think we're all doing that. I mean, I think all of the people in this cohort are generating some degree of revenue, but like, where are you going with that? Like, even if it's just a small amount,
it doesn't matter. It doesn't matter. Remember the first question that Simon asked. So when you are generating revenue, you're in business and you can actually claim the expenses. That's going to reduce your tax bill. Yeah, so
any kind of revenue that we can, revenue is a legitimate expense that we can claim on our taxes. Is that what I heard you say?
So revenue is income, and revenue is something that you sell a product, you sell a service, you sell coaching. You sell something, a product or service or something, you deliver something for someone else in exchange for money. That's revenue to you. It could be a commission, it could be an affiliate, whatever it is. When you have your business set up, if you unlock that revenue, then you're not bound by the startup rules that you cannot take the expenses, and then you don't have to capitalize the expenses. So now I can take advantage of all these expenses that I'm putting in. It's going to take me negative. But to go negative, you've got to have the revenue coming in. You can't have negative just expenses with no revenue coming in. Like,
So
let
let
me
me
give you
see
an
if I
example.
can let me see if I can reword
Mhm.
this to what I think Lori might be driving at. And Lori, obviously correct me if I'm wrong. Let's say I'm a W-2 employee,
Mhm.
and based on that W-2, my tax liability after all is said and done is $9,000.
Mhm.
On the side, I'm starting this company, and the company has all these expenses that I'm incurring. Is there a way for me to use those expenses to reduce my $9,000 tax liability?
It doesn't work like that. It goes in a bucket, you guys. Listen, all the income they have, W-2 income comes in here. Like, I understand you guys have LLCs and some sort of like income, depending how you got, like it could be self-employment, S Corp. If it's C Corp, it's a completely separate entity. If you're a C Corp, if you
Most
have
of us are C Corp.
C
So
Corp.
if you can speak to C Corp, that would benefit most of us here. Yeah.
So C Corp is a completely different thing because C Corps will not touch your personal income tax return. So C Corps will not touch that. So all the money that you put in is going to stay as a loss in the C Corp until you can actually generate revenue. So C Corps, if that's what you have, because you're going to have investors and all of that, has nothing to do with personal. So unless you create another set of entity that would kind of be a management company in between, that's a pass-through entity, that's probably the only way. And that only makes sense depending on how much income you might generate in your W-2 and how much of an expense you have in your C Corp that you're trying to offset. Okay. So, I wish it would be an easier way, but that's really the other way, the only way that you can do it because you're separated. Personal income tax, there's no tangency to the C Corp. What I would say though to the C Corp is, are you making contributions to the C Corp, or you're loaning money to the C Corp? Right. Those are the other pieces that you can take a look at, but those are the only two components that you have right now in it. Does that answer your question at all?
Would you describe the two, those two concepts you said, contributing versus making a loan? And can you just talk about those two and how those might benefit or impact the finances in a Delaware C Corp?
Yeah. So one of the biggest impacts that you might have when you have a C Corp, when you make contributions, it's part of equity. Okay. So, when it's equity, when you sell it, if the purpose is to sell it, it's going to come and, have a higher basis. So your gain when you sell it in the end is going to be lower. Okay. So when you sell, you want to have a higher equity in the company. If you're not sure if you're going to sell the company or not, many people, what they do is they just loan money. How is that efficient? Let's say if I forecast that I'm going to break even in one year and I'm going to have high profits in year 2, let's say, I can take money out as a loan repayment without having any type of income taxes from me as an individual. From a C Corp, one of the things that you have to understand is there's only a couple of ways you can take money out of it. You can be an employee, or you can have dividends. Okay, you can take distributions. You can, or if you loan money, then you obviously get repaid. But distributions are being taxed. Dividends are being taxed. Wages again are being taxed. So loan, it gives you an opportunity to get repaid from the higher profits when they hit, and you can create any agreement you want between yourself and the corporation. Say, you know what, I have $100,000 that I have to put in. I'm giving you an example. So I put 100,000 in. I can have an agreement between myself and the corp, the Delaware C Corp, saying, I am lending this money, $100,000, with no interest for 12 months. The first payment begins after 12 months, whatever the grace period would be. After which we pay a 5% per annum interest rate, paid monthly at this rate. It can be repaid, renegotiated, whatever you want to say in it, but you have like a note, and you give yourself how much time you think it's going to take you to break even or to actually generate revenue and have profits. So you can take the money out. That's really it. It's how you get taxed, because then that's the money that you can take without being taxed. Does that help?
Yeah, that is very helpful. And then, so the process of doing that, I mean, it's just a note and you merely keep up with it in your books. I mean, is like, as far as like following it and tracking it, what are the processes required to like follow up on that and like make that a legal process?
Yeah, so you make it very legal. Like you have to be compliant, especially if you're going to seek investors because they want to look at your financials. So it goes on your balance sheet. In the end, it goes on your balance sheet as a liability. You put a long-term liability. You can do whatever. Like I had people that, have to put the 500,000 in. That some people have to put $1 million before they can generate anything when they're building, right? So, and the note is a legal document that you can create between yourself and the company. And there's a lot of legal advice companies that can create a note for you that's applicable to the state that you live in. So it has to be compliant with both the state you're living in and the company because it's in Delaware. Okay. So having that in place, I mean, I know Rocket Lawyer has something online. Again, I'm not affiliated with any one of them. I think legal, there's just so many sites. I have a few of them. Just the name, they're all kind of the same. Legal advice or legal something.
Zoom, I think, is one.
Yeah, so you can create the whole note. And what we do, with our clients, every time we loan money, we have a note and we have an amortization schedule, right? Every time you have a loan, and it tells you this is the repayment schedule, right? This is the monthly repayment, and you want to be really compliant with that. That payment, once you, if you didn't, refinance the loan, so to speak, right? And if it's following the same schedule, you've got to pay yourself back. So if it's $1,000 a month, you have $1,000 a month payable on the first every month to be compliant. And then you say this is principal and this is interest. And the only thing you would pick up on your personal tax return as tax impact would be the interest, right? But it's your money that comes from one entity to the other. That's the only piece that will be taxable. So again, you don't want to have a high interest. You can have prime or whatever, prime plus one, whatever the lowest you can go. Makes sense?
Yeah, thank you. That's very helpful. Yeah, that makes a lot of sense.
Yeah. Any other questions that you guys have?
Carl, did you have anything?
No, I think this is good.
Yeah. So, how far are you guys into the developmental process for your applications?
Every one of us has a product that is ready for use and ready for customers.
Okay, so you are generating revenue then. Then all of you are generating, maybe not the core product that you're still working on, but you're all generating revenue then.
No, that mine is, I mean, I just got into the marketplace. I have a DIY tax filing app for personal taxes.
Mm-hmm.
And so I just went to the tax season opened up 3 days ago. So we're now looking at downloads and hopefully adoption will come quickly.
Mm-hmm. Yeah. So the other piece that I would really recommend for you guys to understand is like when you go to investors, how that's going to impact how much, what's the exit. So when I bring investors in, I always look at what's the exit and how that's going to impact your tax, how that taxable event will take place for you, and where will you be at that point? Will you be employed, married, having kids in college, no kids? There's so many questions that go in that. Because with the C Corps, and then, when do you plan to exit if you're going to exit, right? Let's say a lot of the SaaS companies want to be bought out. What's the minimum you can hold? There's that small stock exclusion 1202, right? How long can you hold it? Can you hold the company for how long to be able to exclude some of the gains, right? So those are, valid questions to have right now.
Yeah, I was wondering if you could kind of wrap up by just giving us an overview of what types of services you could offer for people like us, new entrepreneurs who are entering their first tax season as Delaware Cs, like what types of services and support you could provide for us, if we hired you to help us out.
Yeah, definitely. So one of the first pieces that I really recommend for when you're in C Corp, and I assume you're in C Corp because you're seeking investors, most likely, right? Or you're going to exit soon. And sorry, my allergies are not cooperating today. So um, one of the first things that you want to do, you want to do tracking. So depending on the level of expenses that you have, and when you're bringing people in, you've got to have an accounting system set up. Okay, that is the basics of the basics. Have it set up in a way that you can track. Now, that's not always necessary. It's only necessary if you're going to bring the investors in and you got to produce financials. So, depending on how far along are you from getting investors in, you might need that. But that's one of the first things that comes in place. In companies that are startup that have high expenses before generating high revenues, many times they need a fractional CFO, not tax, because C corps are very tax efficient in many ways before they generate a lot of revenue. What you want to do is a fractional CFO to look at your budgeting and forecast. These are the most crucial pieces that make or break a company at this level. And for a company outside of yours, we don't recommend this until they make $1 million in revenue. But in cases like this, you don't need the full CFO. There's fractional pieces that you might review every quarter, not even every month. Looking at, hey, what am I doing this quarter? What's the implementation phase? Those are the pieces that really the metrics that are the KPIs that you want to track to see, am I on track to produce this? What's the profitability that I'm looking? What's my break-even point? What's my margin of safety? When do I pay myself? How am I going to make money out of this? Right? So all these pieces get to be analyzed before you get the revenue coming in, right? Plus, when you go get the investors in, you've got to have the to produce the financial. So these are typically the items that I see coming in. Now, if you have on the side, so this is your development on the C Corp side, what I recommend. On the personal side, if you, let's say, have a high paying job, 100,000 plus, if you're married, if you have minimum $150,000 in income, you've got, let's say, a rental property, or you've got any other sources of income that are coming in, I recommend if you're at $150,000, you've got a tax planning for yourself. And that's the level where I mentioned earlier, could we add, a management company for you? Could we add anything else so you can save money? Because you keep putting money in a C Corp and we really don't have any advantage on the personal side. But that you need a minimum $100,000 to $150,000 in income coming in to do tax planning. What can you do to minimize the tax liability personally? So there's two separate things that I recommend. And that's where we come in. Yeah. Does that help?
That's
Lori?
great. Yeah, thank you so much. Yeah, I really appreciate that. That was a nice wrap up, and it's a really good opportunity for us to kind of like understand, what options we have and how to move forward, et cetera, in this kind of new circumstance. So I appreciate your time today, Laura. It's been really helpful.